My name is Kaniff, and this is Fox News. What minimum level of a bank's money should come from its owners? Who better to ask than our own Minister of Finance, Grant Robertson. Grant, why is bank capital an important thing to consider?
Well, Ken, bank value as a major topic here can be looked at in two different ways, from the bank's perspective or from the depositor's perspective. To the bank, an increase in capital requirements signifies a decrease to both book and market value. To the depositors, however, the same increase creates a safer banking system and suits the risk appetite of New Zealanders overall.
Well, Donald has an interesting perspective. He is all against this new regulation. What is your opinion, President Trump?
This is the worst bank regulation in the history of bank regulations. Firstly, the RBNZ have done a lot of overseas research into the historical data comparing capital requirements and the state of overseas economies, mostly in the US and UK. This is incomparable, however, as it doesn't consider the moral hazard factor of deposit insurance when applying similar restrictions from overseas to New Zealand. We know deposit insurance creates an incentive for banks to adopt more risk than without it. More capital means more contribution from owners, balancing out the moral hazards. Bank owners will want to protect their own interests. In New Zealand, however, we will see an overcautious approach as bank owners' money stands at the forefront of consumer loss absorption in place of insurance. This is going to slow down growth and counteract the whole purpose of lowering the OSR recently to 1.5%. Capital-constrained banks struggling to meet the threshold will have to pass up lucrative opportunities because they don't have enough money free from more of it being tied up at the central bank to meet capital requirements. This will force banks to have a higher proportion of equity financing, which could mean some banks won't reach their optimum level of debt and tax deduction on expenses. Since they will pay more in the form of dividends, banks will come up with other ways to make up for lost profits at the expense of depositors. Ultimately, complying with international standards like Basel III is not ideal for the New Zealand economy, as we have a unique composition of banks and regulation.
Thanks for your input, Donald. Now let's hear the other side of the story from Hillary.
The purpose of increasing capital requirements is to safeguard New Zealand from a banking crisis. The PwC study finds that New Zealand's major banks are conservatively capitalized on the basis of international comparability. This is a weak argument. Jurisdiction comparison is less important than selecting a capital requirement that promotes a safe banking system. With this proposal, the probability of a banking crisis occurring will change from once in every 33 years to once in every 200. There is likely to be an increase in borrowing costs for New Zealanders as the banks pass on costs of raising more capital. Three justifications for why the increase would be moderate are the Modigliani and Miller theorem, competition theory, and empirical evidence. In fact, this proposal is only estimated to increase the interest rate by 0.2 to 0.4%, reducing steady-state GDP by 0.1 to 0.5%. This cost acts as the insurance price New Zealanders must pay against a bank crisis occurring. A small cost to the economy now is preferable to the output decimation, credit crunch, and long-term negative indirect effects on well-being that a bank crisis can cause. Following Basel III, RBNZ's proposal takes into account new buffers and closes the gap between the IRB and standardized approach. Additionally, the increase in the conservation buffer is a strong move. It gives banks room during economic ills without triggering the hard minimum. Australian bank subsidiaries have had handsome profits in the New Zealand market. In 2018, ANZ's profit was $2 billion. The conjoint $20 billion increase in equity required over the transition period can be covered by the Big Four banks' retained earnings alone. If a bank crisis occurs, New Zealand is in a unique position because 90% of deposits are held by foreign banks. It is unreasonable to expect a foreign government would bail out a business subsidiary. Therefore, if anyone were to pay for the cost of keeping New Zealand banking safe, it should be the banks and their shareholders, not taxpayers.
Thank you for that argument, Hillary. Grant, what is your opinion?
Overall, I'm in favour of this proposal. Although the downsides of capital requirements will be borne mostly by the banks, the benefits to society are greater, depositors are safer, and more so protected from the large, overly profitable Australian subsidiaries in New Zealand. And although we cannot completely avoid a crisis, a 1 in 200 year probability is something the government's willing to accept.
Well, thank you guys for listening. My name is Kaniff, and that's it with Fox News.